Hi guys, we are going to do another practice question from March-June 2020 attempt. Let's see its requirement first of all. The requirement is to identify, describe 8 audit risks and explain the auditor's response to each risk. As I said previously that we are just identifying risk. Here we are just doing a risk identification activity and not the auditor's response activity for now. So let's start identifying the audit risk one by one. So while reading, I'll be telling you that what's the risk here and how will you explain the risk there, okay? All right, so this is 1st July 20x5. You are an audit supervisor of Orange Company, planning the audit of a new client, okay? So there is a new client, Scarlett Company, for the year ended 31st May 20x5. And the nature of Scarlett Company is it manufactures chemicals for use in domestic and commercial cleaning products. So, guys, whenever an audit firm gets a new audit client, always remember that the risk here is always a detection risk. How will you explain it here? Because you will explain it that audit team will not be so familiar with the balances, with the transactions, with the accounting policies of this client, and also we'll have a less assurance on opening balances because we didn't conduct the audit last year. So that's why our detection risk will be increased. So whenever there is detection risk, you know that it is on the part of auditors, okay? So auditor will need to obtain more sufficient appropriate audit evidence by implementing audit procedures. So this was the first risk that we identified here. Then comes the company's financial accountant was taken ill suddenly in May 20x5 and is unable to undertake the preparation of the year-ended draft financial statements. As a result, the company recruited a temporary financial accountant in early June 20x5 who will prepare the draft financial statements. Also, the year-ended financial statements needs to be finalized quickly as the company is looking to raise finance through a bank loan to replace 3 machines in production facility. The bank has asked for a copy of the audited year-ended financial statements by the end of the September 20x5 before they will agree to the loan, and the directors are keen to report strong results in order to obtain this financing. So basically, there are two risks involved here in this paragraph. First of all, the company's financial accountant was ill, and in replacement of him, the company recruited a temporary financial accountant. Now, what will happen? What's the risk here? There is a risk that uh, this temporary financial accountant, in auditor's point of view, may lack in terms of experience, and um, he may not be very experienced, and so you can explain it because of lack of experience. And also he will have less understanding about company's activities, so there could be many errors or and omissions in the financial statements. Please remember guys, you will do it in 2 steps. You will explain the risk and you will link it in with, link it with financial statements. Okay, so we have to tell where is the overstatement, misstatement, or understatement, or where the disclosures are inadequate. Here, because of his lack of experience and less understanding about the activities of the company, we are afraid that he might do a lot of errors or omissions, or we can say misstatements in financial statements. So this was the second risk. Let's see the next one. As you know that the management of the company wants to prepare and wants the auditors to complete the financial statement audit of financial statements by the end of September 20x5, and the directors are keen to report very strong results in order to obtain this financing. This is a key word which is telling me that there is a strong risk of manipulation in the financial statements. They want to report such a good result in the form of financial statements that they obtain the secure financing. Okay, so I have a risk that they will try to overstate their income and assets and understate their expenses and liabilities. So this was the third risk here. Let's read the next paragraph. In the year, company also purchased a specialized machine to develop a new range of chemicals for a major customer. Only trained staff are allowed to operate this machine, and staff members had to undertake 2 days of training, followed by an assessment at the end of the training period. The training cost of 15,000 have been capitalized as a part of the cost of the asset. Tell me, guys, what is the risk, or what the management has done wrong here? Is there a risk? No, there is not a risk. Basically, they have undertaken a wrong accounting treatment. Tell me, guys, can we capitalize staff training cost? Please, in respect of staff cost, be very careful that if that staff is used in some kind of site preparation, installation of machinery, then only you can capitalize the cost of staff, okay, in cost of asset. But if it is related to the training of staff, then training cost can never be capitalized. You know that, because we cannot control the staff, okay? So they can leave the organization at any moment. See, so we are always standards guide us to expense out the staff training cost in statement of profit and loss instead of capitalizing it in the cost of the asset. So they have undertaken a wrong accounting treatment. That's why what has happened already, that the assets are overstated and expenses are understated. So explanation and link with financial statements. This was the fourth risk here. Moving forward, we have to identify four more and explain four more. The company sources many of its raw materials to be used in the chemical manufacturing process from an international supplier, and goods can be in transit for up to 3 weeks. The agreement with the international supplier contains a clause which states that Scarlett Company is our client, the client of the audit firm, is responsible for the goods as soon as they leave the supplier's warehouse. Okay, guys, tell me, if there is a condition in the contract with the supplier that when they will dispatch the goods, the company, the buyer, will be responsible for the goods, whether are they damaged on the way till they reach to the premises of the Scarlett Company, or they reach without any damage. It's the responsibility of Scarlett Company. It means the control is basically transferred on the point of dispatch from the supplier. So what clicks in mind, that Scarlett Company should recognize the purchase expense and should recognize payables in their accounts on the point when supplier dispatches the goods from their premises, because it's written in the contract with the supplier that this client is responsible for the goods as soon as they leave the supplier's warehouse. So our risk is basically this: inventory might not have been recorded in the books of Scarlett Company until they reach their organization. So we have a risk that their inventory is understated, their purchases are understated, their liabilities are understated. So you can say purchases and liabilities are understated. This was fifth risk. Moving forward, you have carried out a preliminary analytical review which indicates that the receivables collection period has increased from 38 to 52 days. So if your receivable collection period is increasing, it means that customers are taking longer time to repay our client. The credit controller has confirmed that some customers are currently taking longer to pay. They have also written this than in previous years, as they are awaiting payment from their customers. So if the receivable days are increasing and they are struggling to pay, they are taking longer to pay than in previous years, we have a very strong risk that some of the receivables might not be recoverable. You have to mention that You have to make a coherent one complete sentence that some receivables might not be recoverable and an allowance for receivable is required. Our risk is management might not have created this allowance for receivables. That's why allowance for receivables is understated. Expense of bad debt is understated and receivables are overstated. This was number 6. Then on 29th May, the directors announced that one of its brands was being discontinued due to a fall in demand for the product. This resulted in 4 staff members being made redundant. The payroll department has calculated for the levels of termination cost associated with the redundancy, and they will be paid in the July 20x5 payroll run. Okay, the directors announced when was this announcement made? On 29th May 20x5, before the year end. So ICE 37 requires when this event is already announced, then the company has to make a provision in its book according to ICE 37 because there is probable outflow of economic benefits. Okay, so according to ICE 37, provisions, contingent liabilities, and contingent asset, you will write that the Scarlet company would require this provision to be recognized in the financial statements. What is our risk? Our risk is if our risk is they might not have recognized this provision. That's why if this provision is not recognized, we think that the related expense and provision is understated and profits are overstated. This was number 7. One more, guys. The directors each received a significant bonus in the year, which has been included in the payroll charge for the year in the statement of profit or loss. 1 minute, guys. Uh, in the uh, in the earlier paragraph, in the paragraph we just did, they have mentioned that uh, they will be paid in July 20x5 payroll run. So we think that they might have included this expense in the next in July's payroll run, and they might have recognized this expense in the next year's payroll run. So yes, the risk was expense and provision is understated. It's correct. Then the directors each received a significant bonus in the year, which has been included in the payroll charge for the year in the statement of profit or loss. Local legislation requires separate disclosure of directors' bonuses in the financial statements. Please remember, wherever local legislation requires specific separate disclosures, they have to disclose it in addition to the IFRS requirements as well. So our risk is the management might not have shown this disclosure, this separate disclosure in the financial statements. That why this will lead to inadequate disclosures in financial statements. This was number 8. We have 2 more risks. Let's identify them because examiner has given you the chance to identify 8 risks out of, I think so, 10 risks because extra risks are given as well. During the year, the company sold a batch of chemicals to a customer for 120,000 at the beginning of May. The customers returned these chemicals because the chemical mix was not in line with the customer specification. Credit note is yet to be issued to the customer and the chemicals have been written down there to their scrap value within inventory. So don't write the risk that because this was not in line with the customer specification, so that's why they might not have write down inventory. If you write this, you'll not get any mark because examiner has mentioned that the customer has written down this inventory to the scrap value or they have written down this inventory. What's the risk here is because they have already accepted the goods and the credit note is yet to be issued. My risk is they might not have reversed their revenue. So that's why here revenue and receivables might be overstated. This was number 9. See the last one. The company usually pays its suppliers by the end of each month. However, due to the financial accountant's illness, the payment run for May 20x5 was not performed until 1st June 20x5. So the payment was made on 1st June 20x5 in the next year. The finance director has informed you that in order to show consistent results with the prior year, they have recognized this payment run as unpresented item on the year-end bank reconciliation. So basically what has happened that they have shown the payment of this supplier as made in the current year. However, they have not issued the payment until 1st June 2025. So if they have not initiated the transaction, how they can recognize this payment in this year's bank reconciliation, BRS bank reconciliation statement as an unpresented item. The risk, this is not the risk, this is an incorrect accounting treatment. This should not be shown as unpresented item, because what will do this will understate payables of this year. And this is also consistent with the fact that directors wanted to show a very strong result in order to obtain the financing. So might be possible they want to understate their liabilities. That's why they have shown the payments as unpresented items, but the payment are not yet initiated, are not yet made. Okay, so the risk is payables are understated here. So you can identify 10 risks, but you will write only 8 risks. So you have the chance that wherever you identify the risk, you have 2 more extra risks here. So you can easily identify 8 risks. So this was for today, guys. See you in the next session.